Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Solutions. Listeners, if you'd like more information about what you hear on our show today, you can contact us in a couple of different ways. You can simply just pick up the phone here in the Rogue Valley at 541-500-4321 or go to our website at jonesfinancialtalk.com. Lots of great content on there, I believe, and Tony believes. A lot of the content that's on there that I think you mostly appreciate is on the radio page. You can listen to all of our past shows through that radio page link. And you can also, most importantly, give us some ideas for our shows, which is the most important topics that we like to discuss on a weekly basis, kind of like the one that we're going to talk about today. I mean, for many, many people that are retired over the age of 73, required minimum distributions are a huge deal. Lots of things to consider and think through kind of in that realm. And the reason why maybe it's more important to talk about it this year than any other is not only because of all the legislative changes that have happened with the CARES Act and CARES Act 1.0 and 2.0, but also we've had some just astonishing performance in the stock market over the last year. And what that means is your required minimum distribution amounts typically go up when your accounts do. So during the show today, Tony and I are going to talk about RMDs. We're going to talk about how they work. Maybe most importantly for a lot of people, the various strategies that we can implement to make sure that we are following all the specific rules that we need to and the regulations and all of the great details that maybe we could help you with when considering RMDs. But Mr. Tony Schor, I hope you're doing well this week. How are things with you, my friend?
Oh, things are good, Nick. I've had an amazing week because all three of my kids and their significant others came over this past weekend. We went out for a big brunch buffet, all of us, and my wife and I just really enjoyed that. So good family, good food, good fellowship. It was awesome.
It's nice to be able just to splurge on the holidays and eat whatever you want, isn't
It is.
it?
It is. I did eat too much.
Me too.
You honed in on that right away. I really did. It was amazing, though. Did you get enough to eat this past weekend? Did you spend
Definitely.
some time with family?
Definitely. Yep. The Easter Bunny was good to the Jones
Oh,
family.
oh, good, good. As it's so funny. I'll never forget. This is years ago. I was at an Easter service at a church, and the pastor, it wasn't my church. I was a guest there with some family. And the pastor he had a big Easter message, right? And at one point he stops, his eyebrows knit together. He gets all serious. He goes, "It's not all about the bunny, you know.
I love it. I love it.
It's not all about the bunny, you know." I'll never forget that line. But yeah, a beautiful time of the year, spring. So that's good. But what have you been doing? You're keeping busy there at the office too, I bet.
Yeah, I mean, obviously around this time of the year, taxes are right around the corner. Most people are asking about 1099s and also trying to create those last minute maybe accounts to take advantage of some tax deductions for last year. So it's always very, very busy between really, in the first quarter and up to April 15th, working with taxes and things like that.
Oh, yeah. I know your office has been very busy, but you always take time to meet with our listeners if they want to get together and set up a consultation. So before we really jump into it, I want to remind our listeners all they have to do is give you a call at 541-500-4321, as you mentioned at the beginning of the show here, and set up a consultation. You and the staff there, you take great care of your clients, and I know our listeners are going to have some questions. So we're talking about RMDs today, and I know they're a big deal for a lot of retirees, and knowing how much you have to take, when you have to take it, all the potential alternatives out there. It's a significant part of any financial strategy, isn't it?
That's exactly right. And probably the most confusing topic for many people before they actually start taking required minimum distributions. Tony, I'll tell you this, first and foremost, I mean, because of the higher returns that our investments have had, in the last year or so, it's not anything to be concerned about, but it's going to lead or could lead to some surprising financial consequences for many older Americans because of those required minimum distributions from their retirement accounts, which,
Right.
as a reminder, today start at the age of 73. And the reason for that is because required minimum distributions are taxed as regular income. And the bigger the distribution, the higher your tax bracket. It could push you into a higher tax bracket and affect many things. So it's very important to get this right.
Well, yeah, and I think that a lot of people think, well, at some point I have to start taking them, but hey, I'm only 65 or I'm only 60. Why do I need to worry about this now? But you really should have a plan going in. And there's a lot more to it. And that's what we're going to talk about today. And I'm sure a lot of our listeners are somewhat familiar with RMDs, hopefully, but even if they're not, give us a quick description of RMDs and what's going on.
Okay, that's a good idea, Tony. A required minimum distribution, or an RMD, is simply the amount of money that you have to take out from your retirement accounts each year, and that begins at the age of 73. And these withdrawal rules were created in the 70s as a way to make sure that the government was able to collect taxes on tax deferred accounts. It's all about the revenue that the government gets as a result of you taking money out of these accounts. Now, as I alluded to in the intro, in 2023, the Secure Act 2.0 did increase the age that those required minimum distributions must begin from 72 to 73. Prior to that, it was actually at the age of 70 and a half. And that age is going to jump to 75 in about 10 years. Now, typically, the RMDs must be taken out of your account by December 31st in the year that you turn 73. Okay. But this is a question that many people ask. Your first distribution can actually be delayed until April 1st of the following year. So that means, let's say in October of this year, you turn 73. Okay. You can wait until April 1st of next year, 2025, to take your first RMD. Now, there is a catch. That's a very specific catch that you need to know about. If you choose to wait until April of next year, you are going to have to take 2 distributions before the end of 2025. And so you better do some tax planning as a result of that, because it's twice the amount, right? RMDs must be taken from employer-sponsored retirement accounts like 401ks, 403bs, and 457 plans, as well as all of your traditional IRAs and IRA-based plans like SEPs, simple IRAs, and SAR-SEPs. Now, Roth IRAs are exempt from those RMDs while the account owner is still alive, but their beneficiaries will be subject to some RMD rules that we'll discuss as well here, Tony.
Oh, sure, and that's a helpful rundown. An RMD information, it's somewhat straightforward, but I think we're going to encounter a lot here that people don't understand. There's enough nuance that working with somebody like yourself on anything RMD related is going to be a must.
It is. It is. And, maybe the most important thing for people to initially consider here is, how do you actually calculate the RMD that you're going to have? Okay. And so an RMD distribution is going to be determined by dividing the balance that was in your account at the end of the prior year, okay, by your life expectancy. And that's just a table that the IRS provides to us every year. So, as an example, let's say you're 75 and you're single. The IRS has determined that you can expect to live an additional 24.6 years. And what that really means is if your IRA balance is, say, $150,000 at the end of 2023, you're going to divide that amount by the years that you're expected to live. And so in this calculation, your RMD would be $6,098. Okay, so you must calculate the RMD for each of your different retirement accounts, but you are allowed to make your total withdrawal from just one of your accounts or any combination of those. There is another area where it may be wise to speak to somebody like a financial services professional because of those specific little nuances.
Well, sure, and here's a big question. How can RMDs impact our taxes? I mean, that's the biggest concern with RMDs, right?
That's a huge concern, especially for estate planning, in my opinion, and normal taxation on a annual basis. The money in your 401k or IRA has been growing for years tax free. But
Yeah.
once that money comes out, it becomes taxable income and it's got to be declared on your tax forms. And so, if you delay your first distribution until the year following your 73rd birthday, and you have to take two of those distributions out, like I mentioned, that could put you into a higher tax bracket. Okay. And so, while everybody's financial circumstances are very unique, there are some potential strategies that you and your advisor should be talking about to help reduce your taxes. One possible option is qualified charitable distributions. I just helped a client do this week. And so, how does that work? Well, if you're over 70 and a half, you can make a direct donation as much as $105,000 in this year, 2024, from a taxable IRA to one or more charitable organizations. And so, that's one option. If you're still on the job, you also may be able to delay some of those RMDs in your employer sponsored 401k or 403b until you retire. Okay. You do have to be aware that you still will have to take withdrawals from any other accounts outside of those employer sponsored plans if you're still working. So make sure that you're discussing your IRAs and other accounts, and old 401ks, for instance, from old employers with your advisor. And so that again is another thing that you should consider. Another thing that also comes up from time to time, you could possibly delay taking some Social Security for as long as possible and instead use your retirement accounts during those years as your primary income, thereby, right, spreading out the tax liability that you could have in future years for an RMD. And so the point here I'm trying to make is those are just three very specific scenarios where if you would have sat down with an advisor and planned it properly, you can figure that out to be to the best of your advantage based on what we know with taxes today.
Sure, and I think a key thing to note. So any tax deferred retirement account, 401k, traditional IRA, if you didn't pay taxes on the money going in, you have to take an RMD at some point and pay taxes. Whether you've taken out money already or not, they're going to require regular distributions out of the account and you to pay taxes on that money at some point. Typically, if you're 73 or older, you have to be taking RMDs. So, really important, and it can affect your taxes. We'll dig into that a little more, but we should probably once again remind our listeners that if they have questions about this or want a retirement plan in place, a retirement income plan that's solid so they don't have to worry about any of this or their RMDs because they're working with a trusted fiduciary, a financial professional like yourself, Nick, how can they get a hold of you and reach you and set that up?
Yep, two quick ways. You can just give us a call at 541-500-4321 or go to jonesfinancialtalk.com and request that meeting in person.
All right. Well, this has been a great show so far today. You've been talking about required minimum distributions or RMDs, and that's the amount of money people have to withdraw from their retirement accounts beginning at age 73 if they were a tax deferred account like a traditional IRA or 401k. And this has been a great one. What do you have for us next on this topic?
So probably the biggest thing that people ask or that occurs negatively as a result of RMDs is what happens if you don't withdraw your full RMD on time. And
Yes.
so if you neglect to take that full distribution, the IRS could slap you with a very steep penalty. Today it's 25% of the amount that you should have withdrawn. Now, if you correct it, if you made an error, for instance, within a 2-year period, they could reduce that penalty down. And it's possible that they would reduce it and waive it if you can show that the shortfall was because of a reasonable error and that you were taking good faith measures to try to rectify that mistake. But ultimately, the easiest way to avoid errors is to have a solid long-term distribution strategy like you asked about, Tony. And this is extremely important when we do income planning for all of our clients. Clearly, RMDs change that scenario for every single person. If you know you want to take a certain amount out, or if you know that your projection says that this is when you're going to start taking X dollars out, why wouldn't you plan for the RMDs that we know are going to happen? And if you're not having that conversation with your advisors, if you're literally sitting down and just not even having that conversation but once a year, how can you adequately plan for that? You've got to think about it throughout the entire year. You've got to think about your specific planning and how that's going to benefit you by having to take this RMD, because it can in many ways, Tony.
Yeah. Well, and you said a 25% penalty, up to 25% of the amount you take out or we're supposed to take out. Plus, you still have to take out that amount. Plus, you still have to pay taxes on it. So you can't just let this go and not do it or miss it and not rectify it within a reasonable time or have a reasonable reason, or the IRS will slap you with that penalty. So, and that's a huge one. I just want to reiterate, let's say you were taking out $10,000 and the penalty is 25%, that's going to be $2,500 a penalty. Plus, you're going to have to pay taxes on the full amount.
That's right.
Out.
That's right.
So,
crazy penalty numbers there.
yeah,
For sure.
yeah, that's the highest penalty in the IRS tax code, I've heard, the 25%. So I think that's really important for people to understand. What do you have for us next?
So a lot of people ask me about what to do with the money when they take it out of the plan. What should we do? And
Yeah.
there's not a lot of ways that you can avoid the RMDs, but you can be strategic with the money once you have it. And so if you need the money to maintain your lifestyle, maybe a good option would be to put into an account that you put that into an account that you have easily can access and take out quickly. Maybe it's a high yield savings account. There's great rates today that are just issued even in money market portfolios. But on the flip side, if you need money in the short or medium term, the most beneficial way to handle it is could come down to your specific personal circumstances. And so that's why I'm saying that the income plan is so incredibly important for you to discuss with your advisor, right? Whatever you decide, whatever is going to fit your specific needs, you got to factor in when and how you're going to take the required minimum distribution, how much it's going to be, and what you're going to do with that money. That's the point.
Yeah. That's a really good point. So important. Now, what is the strategy for somebody who has more than one IRA, Nick?
Okay, that's a great question that comes up all the time. And so if you have multiple IRAs, you have to determine the necessary RMD for each of them. And the entire distribution that you have to take when you add all those together can come from any of those to meet the distribution, as long as the entire RMD amount is taken out of your accounts for the year. So an example, if you have 3 IRAs, you can take your total RMD withdrawal from just one of those accounts. Okay, now 403B plan rules, which is important for me to discuss because there's lots of locals here that have 403B plans, like IRA rules, because their total distributions from 403B plans may be taken from one or multiple accounts. Now, things are a little different with 401k accounts, though. And so if you have more than one 401k account from previous jobs, each of those plans will specifically calculate how much you have to take, and they're going to provide you with a distribution. And so, another thing I just wanted to mention, Tony, is the months before you turn 73 are going to be an ideal time to sit down and thoroughly review how your retirement accounts are structured. Can you consolidate them to make things a little easier for yourself when it comes to things like this? If you have multiple accounts that require these distributions, are you specifically explaining that? And is your advisor helping you with it to come up with the correct withdrawal strategy for you specifically? That's the point.
Yeah, you have to be working with a financial professional like yourself. Talk about it with you well in advance of needing to take out those RMDs. And you've explained previously that RMDs can be taken in lump sums or installments. I know you've mentioned that on a past show. Is that correct? Do I have that right?
That is right. A lot of people do choose to take their RMDs throughout the year on a monthly basis, and this may be especially wise, for those who intend to use that money to cover monthly bills. Clearly, some people prefer a lump sum RMD payment instead. Some people strategize taking their lump sums early in the year, just so they can cross it off their list and have things done. Others choose to wait till later in the year. If you choose to wait, obviously what's going to happen? Well, hopefully, if the market helps us, or if you're in some type of an interest bearing account, then your investment will grow more before you take it out, continue to be tax deferred. There's no right or wrong answer when it comes to taking installments or taking it as a lump sum. It comes down to your personal situation. I mean, some of my clients like to have it in the fourth quarter so they can pay things like their property tax bills. Others take it quarterly so they can pay the estimated taxes. Others take it monthly so that they can add it to their income and just live on it. Um, Everybody's different. And depending on other income sources that you have, like Social Security, we need to figure out if there could or would be any impact on how much of your Social Security could be taxable based on you taking required minimum distributions. And so you should be talking with your advisor about tax brackets and your specific situation to come up with the best strategy to save you the most, knowing that you're going into the year required to take money out.
Right. And so I know this is an important part of the whole process. And also, your Social Security, that's an important point that it can be taxed, and that's determined on your annual income, how much of your Social Security is taxed. And so taking an RMD could put you into a higher income tax bracket, and therefore more of your Social Security will be taxed too. Is
That's
that
right.
what?
Provisional income, options with taxation for Social Security do add in total income. So you're exactly right.
Yeah. Well, and I think this is really important. What do you have on the agenda next?
Okay, so maybe we could spend the rest of the time on the show today focusing on a very important topic that's changed a lot recently, and that's what the RMD rules for beneficiaries of IRAs are.
Ah,
Okay.
okay.
And
So when you leave your IRA to me, I'm sure that the beneficiary designation on yours says Anthony T. Shore.
yeah,
I've got
it
a
does not, but let me explain to you
oh,
if I did how that would look, Tony.
okay.
So these rules all changed with the Secure Act 2.0. And it really changed so much of the inherited IRA rules. And think about why. Everybody asks, what's the deal with RMDs? What's the deal with inherited IRAs? Well, generational wealth has just continued to be deferred, into the future. And the government and the IRS wants their part of the revenue. And so they've given you the ability to put the money away, but now they're going to want it eventually. Okay. And so one of those pieces of the legislation requires that inherited IRAs have to be distributed or withdrawn, okay, by the end of the 10th year following the owner's original death. Okay. And so that 10-year rule applies regardless of whether the participant dies on or after the age at which they had begun their RMDs. And so this means that you must withdraw what you inherited within a 10-year period and pay income taxes on that money. And because these withdrawals are required, there are no early withdrawal penalties like the 10% penalty if you're younger than 59 and a half. In addition to paying taxes on some of this money, you also must empty the account over time because it's got to be completely closed out in 10 years.
Yeah. Okay. So there are a lot of rules here that people need to be aware of. Are there any exceptions to that 10-year rule?
There are some beneficiaries of these IRA accounts whose owners passed in 2020 or later are exempt from this 10-year rule, and you have to be what's called an eligible designated beneficiary. These are people like your surviving spouse, a disabled chronically ill person, a child of a deceased person who hadn't reached the age of majority yet, and a person not more than 10 years younger than the account owner. And these beneficiaries aren't obligated to spend that IRA down within a 10-year period. And they have until December 31st of the year following the IRA owner's passing to start those withdrawals. But if the account's original owner was supposed to take an RMD in the year that they died and hadn't, the beneficiary must take that RMD for them in that year, and then move forward with their own rules.
Right. Right. So there's a lot. You can get deep in the weeds here. Again, you're just illustrating the point of why we need you, Nick. We need a solid financial professional in our corner. And I think that's why that's a good idea. There are enough rules and regulations here.
There are so many rules and regulations, and the whole point is, if you're working with somebody that understands the process, understands the current tax rules and laws, then they will be able to help you structure things correctly to save you the most in taxes and to give you the best opportunity for this money to last a lifetime. That's the whole point. You've got to follow those special rules. There are special rules for surviving spouses, right? They've got more flexibility than people that are not spouses. There are currently disadvantages to having trusts and estates named as the beneficiaries rather than a real person. And so you have to just know that if you structure things incorrectly, it could cause some difficulty and much more taxation and time issues for any beneficiary that you intended to give that money to.
Okay. So what happens if an IRA has more than one beneficiary?
Okay, so when there's multiple beneficiaries, an IRA may be divided into separate accounts for each of them. Okay, and this typically happens, when they're non-spouse beneficiaries that are subject to that 10-year rule we talked about. And so you just have to split that IRA by December 31st of the year after the original owner's death. That's
Sure.
the main requirement.
And where do a Roth IRA, where does that fit into this?
Okay, so I'm glad you brought that up. So the inheritance rules governing Roth IRAs can be very confusing. A Roth IRA's original account owner never has to take RMDs, but someone who inherits a Roth IRA does, unless they fall into one of the exception categories that we discussed above. So, you do definitely have to understand that and how it's going to work.
Yeah, for sure. Well, this has been a great show today. We're almost out of time, Nick. Things just flew by, but RMDs are obviously important. There's a lot to know here. So before we go, let our listeners out there know how they can get a hold of you and set up that consultation to get a plan in place or get a second opinion on where they're at and make sure they have a solid retirement income plan in place that includes RMDs.
Sure thing. You can just give us a call at 541-500-4321 or go to jonesfinancialtalk.com and request a consultation so we can discuss these things with you.
All right. Well, Nick, great show. Listeners, thanks for tuning in. Viewers, thanks for watching. That does it for today's episode of Jones Financial Talk with our host, Nick